Selling investment real estate is much different than selling owner-occupied homes. If any property receives income for a period of time, it is considered an investment and subject to investment rules. If you do not live in this house for a period of time and you rent it out, it is not your personal residence and it is considered a rental. Houses that are rented out are considered rental income investments, and they are also subject to IRS guidelines. I thought I would use two identical houses, same price, same long-term hold, and see how the differences play out. Both houses are valued at $300,000 and have been held for 10 years, and both houses have a basis or a beginning purchase price of $200,000. Now we could add debt, but we won't at this time. IRS guidelines say to get a total 1031 tax-deferred exchange, you must go equal to or up in debt and price, plus you must invest all the sale proceeds. There are no such requirements for an owner-occupied house in this price range. You are allowed to sell the house, take the money, and reinvest in any way you like or not invest at all. As an owner, you also get mortgage interest deductions every year that you own the property, which is kind of like cash in your pocket. Now that sounds pretty good to me. However, investment real estate is allowed to deduct all the interest paid, plus all expenses of operation, all maintenance, repairs, and depreciation. Another benefit is any capital improvements that you make to the property will add to your basis and will reduce your future tax bill. Now what's really good is the investment generates monthly income each and every month that you own it. So how nice is that? The kicker is when you sell, you have to recapture depreciation at 25% and pay capital gain at 15 or 20% depending on your tax bracket. To avoid that tax bill, you need to reinvest in an equal or larger like-kind investment with equal or higher debt. In this example, the owner must reinvest all the proceeds or pay about $33,600 in tax. I've already done a basis calculation, and that sounds bad, but it's not so bad. Remember, the tenant is paying for the house, giving you cash flow and long-term profit through appreciation and depreciation. Returns on rentals can often be in the double digits if the investment is a quality investment. Or you have another option, that is to pay the tax, put your funds in a low-risk bank, and receive low returns, and that's called safety and investment. To sum it up, there are many options to an investment exit plan when you are tired of investing. A 1031 tax advisor can advise you and guide you to the simplest exit plan that won't cost you an arm and a leg. So to all agents and clients, there is a big difference, and the difference starts at the listing contract and the intent of the owner. Now, the IRS has often disallowed 1031 exchanges because of lack of investment intent on the part of the owner. The differences in the two house listings in this example continue right through closing the deal, even though the structure, the houses are identical. Now, 1031 timelines are strict, and the use of a qualified intermediary is required, and following the rules are very strict or the exchange will be disallowed. You cannot have any access to the funds until the exchange closes or 180 days are over, or you will pay the tax. Now, the IRS is kind of touchy on this subject, and no, your title company cannot just hold the funds because you still have access to those funds. Now, as a broker, if you have not figured out the differences in these two identical properties, then you are way outside your area of expertise and can easily harm the client. You should know how to do a preliminary basis calculation, and you should know the basic requirements of a 1031 tax-deferred exchange. Now, here's a call you do not want to get, and it's scary. Imagine that after closing, a client calls up and says, "Hey, I had to pay $33,000 to the IRS because my house was considered a rental for 10 years, and you didn't tell me about that." Now, what can you do about it? Now, do you think this client wants you to pay? I think so. Now, sure, the contract says the client should seek the advice of a CPA or a tax attorney, but you as an agent have an obligation, and you should have known the drill at the time of the listing, and you should have been able to guide or even push the client to the experts. Now, this looks like a bad hair day to me. Thanks for watching. This is Chuck Trice with Investment Tuesday.